Phase 1. The number that defined you. You did not build an 820 credit score overnight. You built it over 11 years. 11 years of paying every bill before the due date. 11 years of keeping utilization below 10%. 11 years of never missing a single payment. Not once. You knew your score the way you knew your own phone number. 820. It was not vanity. It was armor. That number meant the bank called you, not the other way around. The mortgage rate they offered was the rate in the advertisement, not the rate with the asterisk. The car dealership did not make you wait while someone made calls. The apartment application came back approved the same afternoon. 820 meant the financial system treated you like someone it trusted completely. You had spent 11 years earning that trust. You did not think about what losing it would feel like, because people with 820 credit scores do not lose them. That is what you believed. That belief is the first thing that had to go. Phase 2. The 90 days. It started with a job loss, not a firing, a layoff. The company eliminated your position. 73 people. One Tuesday morning, clean desks by noon. You were not unprepared. You had 3 months of emergency fund. You had skills. You had a network. You started applying the same week. What you did not have was a realistic timeline for how long a job search at your level actually takes. Not 3 months. 4.5. The gap between 3 months of savings and 4.5 months of job search is 6 weeks. 6 weeks of living on credit. Month 1. Everything is fine. You are paying minimums on everything. You are protecting the score. You know what you are doing. Utilization is creeping up but still manageable. Credit score. 791. Down 29 points. You notice it. You are not concerned. Month 2. The emergency fund is gone. You missed the mortgage payment by 4 days, not because you forgot, because you were moving money between accounts trying to cover everything and the transfer did not clear in time. 4 days late. That is all. Your lender reports it as a 30-day late payment. Your credit score, 684. Down 107 points in 30 days. You stare at the number the way you would stare at a car accident. The specific shock of understanding that the system that rewarded 11 years of perfection can erase a significant portion of it in a single month. Month 3. 2 more late payments. Not careless ones, desperate ones. You are choosing which bills to pay and which to delay. A calculation you never thought you would be making. Mortgage first, utilities second, credit cards last, the credit cards report, 2 30-day lates, 1 60-day late. Your credit score, 531. You apply for a personal loan to bridge the gap. Just enough to catch up. Denied. The denial letter arrives the same week as a job offer. Finally. But the damage is already done. Day 91. You have a job. You have income again. You can pay everything going forward. Your credit score, 482. 338 points gone in 91 days. 11 years of work. 91 days of circumstance. Nobody warned you that the system is not symmetrical. Building credit is slow. Losing it is fast. Phase 3. What 482 actually costs you. Here is the part nobody explains until you live it. A credit score of 482 is not just a number. It is a tax. A tax on everything you now need to do to rebuild your life. Housing. Your lease is up in 60 days. The landlord runs your credit. Application denied. You apply to 3 more apartments. All 3 denied. The 4th one accepts you with conditions. 3 months security deposit instead of 1. $3,600 up front instead of $1,200. Money you do not have easily. Money you find anyway. Because you have no choice. Car insurance. Your policy renews. The premium goes up $1,400 per year. Not because you had an accident. Not because you got a ticket. Because your credit score dropped, and most states allow insurers to use credit scores in premium calculations. $1,400 per year. $116 per month. Extra. For the same coverage. On the same car. Same driving record. The system charges you more for being less financially stable. The irony is not lost on you. Credit cards. Two of your cards reduce your limits, not because you missed their payments, because your overall profile changed, and the risk algorithms adjusted your limits automatically. Reduced limits mean higher utilization on the same balances. Higher utilization means the score drops further. The score dropping further means more limit reductions, a spiral that requires no new mistakes to continue, just the mathematics of a damaged profile interacting with itself. The personal loan you eventually need, you find a lender willing to work with a 482 score. The interest rate, 29.9%, the same loan you would have received at 6.2% 18 months ago. The difference in interest over 36 months, $4,800? $4,800 extra, not because you borrowed more, because the score says you are a different kind of risk now. The system is taxing the circumstance that already cost you everything. Phase 4. The psychological reality. Nobody talks about this part. The financial content talks about strategies, hard inquiries, dispute letters, secured cards, credit builder loans. All of that is real. All of that matters. What the content skips is the 43 days between starting the rebuild and seeing any movement in the number. 43 days of doing everything right, paying on time, keeping utilization low, not applying for anything new. And the number does not move. Not yet. You check it every 3 days. You know you should not. You do it anyway. The way you check a wound you know has not healed yet but cannot stop looking at. There is also the specific shame of a financial identity crisis. You were the person your friends called when they had credit questions. You understood the system. You played it correctly for 11 years. Now you are being denied for a secured credit card with a $300 limit. The gap between who you were financially and who the system currently sees creates a cognitive dissonance that is genuinely difficult to carry in ordinary life. You do not tell most people. You develop a practiced neutrality around money conversations. You learn to change the subject before it reaches the territory you cannot enter. Phase 5. The rebuild. Month 4. You have income. You are current on everything. The rebuild begins, not dramatically, not with a single strategy, with a specific sequence that the system rewards and that most people do not know exists. Step 1. The dispute. You pull all 3 reports: Equifax, Experian, TransUnion. You find 2 errors. One account reported as 60 days late that was actually 30 days late. One account showing a balance that was paid in full 2 months ago but not updated. You dispute both. The 60-day late corrected to 30-day late adds 14 points. The paid balance cleared adds 11 points, 25 points from paperwork, not from time, from accuracy. Step 2. The secured card. You open a secured credit card. $500 deposit, $500 limit. You use it for one recurring bill. Netflix. $17.99 per month. You pay it in full 3 days before the due date, every month, without exception. The card reports to all 3 bureaus, a perfect payment, every month. A new positive data point being added to a profile that currently has more negative ones than it should. Step 3. The credit builder loan. A community credit union offers a credit builder loan, $1,000, 12 months. The money goes into a locked account. You make payments. At the end, you receive the money. It is not about the money. It is about the 12 months of on-time payments being reported to the bureaus, 12 data points, 12 months of evidence that the 482 is a moment in time, not a permanent identity. Month 6. Credit score. 561. Up 79 points from 482 in 90 days of rebuilding. Not because the late payments disappeared. They are still there. They will be there for 7 years. But because positive data was being added faster than the negative data was being weighted. The system rewards consistency even when the history is not clean. Phase 6. What the system does not tell you. Here is the uncomfortable truth about credit scores that nobody in the financial system has an incentive to explain. The score is not a measure of your character. It is a measure of your behavior as captured by 3 private companies whose algorithms are proprietary, and whose errors you are responsible for finding and disputing yourself. The scoring model is not neutral. A single 30-day late payment on an otherwise perfect 11-year history can drop a 820 score by 100 points. That same late payment on a 580 score might drop it 60 points. The system punishes the people who had the most the hardest for the same mistake. The recovery is asymmetric by design. It takes 11 years to build to 820. It takes 91 days to reach 482. It takes approximately 3 to 4 years of perfect behavior to return to the 700s. It takes approximately 7 years for the late payments to age off completely. The math is not designed for your benefit. It is designed for the lenders who use the score to price the risk they are taking on you. Understanding that changes how you interact with the system. Phase 7. The number now. 3 years later. Your credit score. 741, not 820, not yet. The late payments are still visible on the report, still being counted, still costing you points you would otherwise have. 741 is not the armor 820 was, but 741 is real, built on a foundation that is now more honest than the 820 was, because the 820 was built on the assumption that nothing would go wrong. The 741 was built knowing that things go wrong, that the system is not designed with your circumstances in mind, that the rebuild requires doing specific things in a specific order, with a patience that the system does not reward quickly, but rewards consistently. You no longer check your score every 3 days. You check it once a month, the way you check a garden you have planted and know is growing even when you cannot see it from one day to the next. Somewhere right now, someone is staring at a number they built over years, watching it fall in real time. They are not irresponsible. They are not careless. They are someone to whom something happened. The system does not make that distinction, but the rebuild does not require the system's understanding. It only requires the next on-time payment, then the one after that, then the one after that. That is all the system has ever actually rewarded. You know this now not because you read it, because you lived it.